All right, welcome back to Protect the Pile, the no-nonsense investment show where we cut through the market noise with a panel of seasoned practitioners who play the game every day. We'll dissect what's going on out there and talk about some of the opportunities, some of the risks, and help you navigate the markets through the Hedgeye risk framework and all the real-world experience we have between this combined group of esteemed collaborators. I am Patrick Kent, or RPK, of Hedgeye Asset Management, and with me, as always, is Sam Rahman. And joining us as well, John McNamara, also a portfolio manager and colleague at Hedgeye Asset Management, and Jay Van Sciver, the international man of mystery, covers industrials at Hedgeye. And welcome, Jay. Thanks for coming on.
Great. Thanks so much for having me.
Yeah, this is a pretty loose format. I'll kind of just level set a little bit, put this episode in place and time, and then we'll kind of get into a little bit up top, just talk macro for a few minutes, and then we'll get into some more industrials related topics, and we can kick it around. Then I've got a few Q&A questions from the audience, and then yeah, we'll kind of wrap it up. So keep it on schedule. We're recording on February 27th. Our last episode was, I think, February 6th. So even though we keep trying to do these every other week, life intrudes. And in this case, it was a snowstorm that kept me trapped in Florida for longer than I planned to, which I guess wasn't the worst place to be, but it was a little more expensive than originally planned. We're sitting here, the S&P 500 is at 68.56 roughly, down about 1.7% from the all-time high set basically, I don't know, 1 month ago. And here we are at month end. There's a little bit of noise going on out there. It's been a strange couple of days recently, right? We're in the chop bucket, volatility's up. We kind of are stubbornly sitting around 1920 in the VIX. Vol is a bit elevated. Kind of just seen it everywhere across the board, which is a little strange, only because the liquidity environment is so supportive, I think, at the moment. At least the way I look at these things, as we've talked about multiple times over some of these episodes. We've had, global dollar liquidity is, as I look at it, which is just global, the major M2 across most of major economies converted back to dollars, that is growing at double-digit rates on sort of 1 month, 3 month, and 6 month annualized, as well as year over year. Looking more US centric, M3 is still expanding at over 5%. So these are all pretty supportive. So which gets to sort of the interesting questions of one, some of the volatility we're seeing and why. I mean, we'll talk a little bit about that. And also just the divergence going on within the markets, because you've got the Nasdaq. If I look at, Nasdaq's really underperformed up until the last few days. You've had small caps outperforming large caps pretty dramatically, and then that's given back some over just a couple of days. But most of all, and the Nasdaq's been actually pretty significant underperformer. Year to date, it's actually down year to date versus all the other indices up. So it's kind of an interesting place to be. High yield, getting a little bit of credit spooking. I don't know. I can't say it's much. I mean, but we have seen credit spreads widen for the first time in a little while. And that's on the back of the 10-year coming down to kind of at least at an immediate sort of term new recent low. And then the 10-year rate. So yeah, let's get into it. That's kind of just the landscape as it sits. So let's talk about it. I mean, we're going to get into this. I think the question of the AI. We'll talk this more about industrials, but I do wonder how much of a lot of it feels like there's a lot of very, very one-sided trades that are kind of on at the moment. I think, John, you've talked about this in some emails you sent around, just say software versus semis, right?
Yeah.
Now, can it keep going? Yeah, I mean it can. So that's nothing that says just because it's stretched, it's going to stop there. And there could be very significant reasons why this is very different. But just historically speaking, we're at a very wide stretch. So I don't know if you want to add some color.
I mean, I think as Keith would say, picking bottoms is a very stinky business, but obviously I think a lot of people no longer work in this business by trying to pick tops. So, certainly things can get extended and, stay extended, as we've seen. It's funny actually, Sam and I were going back and forth earlier, just on Bloomberg about all this stuff in AI and I don't know. I mean, is raising capital just continuously, like, is that a good thing? It seems like it's a great thing, but I guess, I mean, maybe I'd throw it to Sam on that one. Sam, obviously, been a lot going on in AI this week. I mean, you know, what do you what do you think? I mean, I, s- software bombshells. I mean, it's certainly has been a minefield out there. So,
Yeah, I think the question is more like what hasn't happened in AI this week. It's crazy, but I don't want to really take up too much time because I really want to. I'm sure we all want to chat to Jay about
yeah,
what's going on in space. But I think just to really summarize, I mean, we're seeing that there isn't any shortage of capital as it relates to spending. You just highlighted, John. I mean, OpenAI is completed its latest funding round. We haven't seen the sovereigns come in yet. That's probably the next funding round for OpenAI, and that's going to be a big number. And then you contrast that and how that affects the Capex cycle for the data centers. And then you see the flip side of that, what's happening with software. And I think to RPK's point, I think the charts that are flying around about how extreme these spreads are, the thing that when you look back those last 15 whatever years, there was no time in those last 15 years where you ever really questioned the terminal value of these software companies, which I think is what we're starting to do now. So that kind of gives the spread issue a different feel to it. I mean, you guys all lived through 2007, 2008. Everybody was trying to call the bottom in banks in terms of look at the price to books. They're so cheap as these stocks were cratering. And what we weren't talking about in later seven and earlier eight is like, what if like some of these guys go bust? And I need to look at this, but I would love to find out what percentage of banks actually went bankrupt in 2008. I would be shocked if it's more than 10%, but that 10%, if it is that number, absolutely just wiped out the markets and the economy. So fast forward that to
Yeah, I mean,
software.
the final number would be hard to tell because we also don't know who would have if things hadn't gotten
If they hadn't
fixed,
gone
right?
bold,
Yeah, I mean,
that's a
that
good
was
point.
like,
Yeah.
yeah, I mean, remember
So
when
translate that to
I have to go
software,
back in
like,
time, but that's like
yeah,
remember there was the moment when Merrill Lynch like basically got taken out on a Monday morning, and it was like, wow, I bet they were like making phone calls over the weekend, like we're cooked if we don't figure out
right,
something, and so
right.
it got kind of a
So,
forced
so, so,
marriage
so,
happened. So
yeah,
yeah,
so
to your point, yeah,
translate that to software. Like, what if only like 5% of software companies disappear?
yeah.
I mean, that's a small number, but just imagine what that does to the valuations of all the other 95%.
Yeah. And there has to be, I mean, this is kind of where we dovetails with some of the credit issues that have been floating around out there. Like, I think one of the things that's been fascinating to me is that I think when you look at junk spreads, and Keith's talked about this a ton on the macro show, right? He's been pretty bullish on high yield and he's held on to it quite a way. I think he's gone a little more neutral recently. If someone can correct me if I'm wrong, but
Yeah,
but when I talked about this with him a couple of months ago, that I thought what might be going on there because he was kind of pointing out this like counterintuitive idea of high yields working, but there's all this stuff floating around about direct lending and like and I think I was like, well, actually, I think what you're end up happening is that you've actually high graded junk. Like that, the people who were the worst borrowers didn't go to the junk market; they went to direct lending, and so there you actually got a seasoning of the high yield stuff where these were now, higher, better, effectively better credits and ones that have had now a track record. So this was a seasoned book. So there's actually a reason why these spreads would come in a little better because some of the worst stuff got pushed to the
yeah,
dumbest buyers. Because it's like I made this comment the other day on X, like I think we learned in '08 to kind of call back again to this is that credit is never like distributed. It actually ends up aggregating with the dumbest person in the room. That's always the way it ends up working. It's like you think it's like, oh, these new financial tools will allow credit to be, the risks to be evenly distributed through the system. And it's like, no, you don't actually like end up smearing that peanut butter across a toast. It just ends up going to the dumbest person at the game, takes on the
yeah,
most risk until they absolutely blow themselves up.
I mean,
And
to that end, right? Like, I know, I think I've said this a million times, but you know, going to like any type of like retail, conferences out there, like retail investor conferences out there.
Right.
I mean, who's there? It's all the private credit
Oh,
players who are
yeah.
trying
I
to,
mean,
syndicate these portfolios into, I know Besant said the other day, we don't want, 401ks chock full of this stuff. Well, that ship may have already sailed.
Yeah.
yeah. And that's so maybe I'll double this. This I will bring Jay in because Jay, you made a comment the other day. I think it was actually more of like in an email or something that, but I really liked it because you framed it as like, we were, we moved capital from sort of like low percent return on capital businesses to higher return on capital businesses. And I think I meant to respond to you in an email and completely forgot. But the thing I had in my head, so we're going to do it live here, was that isn't it fascinating that actually these returns on these businesses might actually be coming down, and therefore what actually ends up happening is the returns on those capital intensive businesses have to go up, and like so you're actually seeing the capital kind of flow from one to the other, and that's what's going to start to continue to evolve here because by definition these businesses are becoming more capital intensive, right? These hyperscalers now their capex is going way faster than their revenue, and the question is like can they keep doing how much can this keep going and what are they doing with it? They're building data centers, they're buying chips. We're going to have to build up more capacity to make chips. We're getting more energy. We're going to have to build up more capacity to deliver power. Like so it just sort of feels like these are now like we went asset light for so long and now we're in this position where we actually kind of have to shift back a bit more asset heavy or asset medium in a sense between the two. I don't know, you want to clarify
Well,
what you
I think it's a great point. I think if we look at sort of the long arc of industrials, right? If we look back to the 90s, right? In the 90s, you had the Soviet Union fall. You had lots of industrial stuff all over the place. Metals were super cheap, right? And the growth in the economy was in software. It was like the Microsoft, the dot-coms, the internet, right? And industrials just lagged. It was a terrible decade for industrials. You come into the aughts, right? You have like 9/11, wars in the Middle East, things that require a lot of stuff, right? Then you have this transition to the growth of China, right? China and emerging markets as a theme just absorbed. People did the calculation. What if everybody in China bought a toaster? You're like, wow, actually that's a lot of copper, right? You do it out and you see a lot of mining investment, a lot of fixed asset investment to kind of feed the boom, the fixed asset investment boom in China. China kind of gives up that growth dynamic around 2012, and we enter like a phase of social media growth, right? And for the next decade, industrials are like right into the pandemic, industrials are like kind of bad, right? They're not a great place to be because all the growth in the economy, that marginal growth was not capital intensive. And enter this phase where you see sort of traditional software getting routed, which is not capital intensive, and you're transitioning to this AI growth and investment dynamic, which I think will prevail, right? It's an incredible technology. It's going to continue to evolve in ways we fail to expect. And it's going to be almost certainly much more capital intensive, right? The idea of real world AI, the robotics, the manufacturing infrastructure, the automation, things like that are all going to be much more stuff intensive, as is the actual computing behind it. And I think that's a promising factor. In order to get that next growth, that next growthy area, it looks more like China entering WTO than it does, Meta or Facebook or whatever it was called back then.
Yeah, I mean, I was bringing this up earlier because we had this news right last night that with the formerly known as Square, the artist formerly known as Square, now known as Block, is had made this big splashy announcement that they're going to cut 40% of their headcount, right? Now, we talked about this a bit on the call this morning. I don't mean to sound skeptical of any of this. It's like, I agree, like there probably are massive amounts of efficiencies that they can figure out. I'm also just mindful of that Jack is like, the dog chasing a squirrel, the next squirrel that is like whatever the new tech thing is that because he's like more of a founder than an operator. So he's always kind of like focused on the next cool thing. And so he wants to be the first one to be out like saying, oh, I'm going to cut 40% of the headcount. We're going to replace it with AI. And like, sure. I mean, you also bloated this headcount for the last few years. But what I got to thinking about was this, how these companies are going to eat themselves a little bit with this. Because like part of the savings is not buying as much stuff from these companies, right? Like it's sort of like, my example being like if Microsoft, I remember having the discussion with like when Microsoft was partnering with OpenAI and to bringing on Copilot. And they were like, they're going to be the first one out. They're going to be selling Copilot. And I was like, well, how are they going to monetize Copilot? That's like very expensive. I mean, to do. So how are they going to monetize? Oh, they're going to charge in addition to the sub, they're going to charge an extra $20 a month, extra $30 a month. They're like, okay, what if we reduce the subs then by 30%? How does that end up being a good thing for them? I mean, it just like all of a sudden it says like, oh, well, you would actually have to charge a lot more, right? Like, I mean, it's maybe a bad example, but I'm just like, all of these companies buy tech. I mean, every company buys a lot of tech. There's a lot of seats. There's a lot of headcount driven like software purchasing. There's a lot of like, and so if we're cutting headcount, you're going to lose a lot of this stuff. They're going to lose a lot of these, and like you can only offset so much of it. You can't offset 100% of it, or the AI isn't totally worthwhile, right? So like it just feels like they're kind of almost eating their own return. Sam, tell me why I'm totally wrong about this.
Yeah, I think that's right. I think post pandemic there was so much hiring and in a handful of sectors, but software in particular. And I think I think Dorsey's doing it in one fell swoop. One fell swoop, but you're going to see other companies do something over a period of time. Other software companies, and that is the issue. I think this issue about like software companies say, hey, we're going to create our own agents, AI agents on top of our software that can provide the productivity for the customer. The problem is they're going to be using or spending the tokens with these LLMs. So your margin on that AI agent is not what you are getting with your core product. So you got seat growth, seat contraction with your customer. You got margin compression with any new AI powered product you're going to put out there, which you have to put out there. So, and then you're facing the questions of terminal value. So, I think the software company that's the first to come out and say, um, we're going to cut, the head count, but we're going to also um, use kind of productivity based pricing on our products, which is going to be low margin. I think that's going to be the model that's going to go forward, but that process is going to be very painful.
Did you see this chart this week in Financial Times?
Oh,
AI could end scarcely end humanity or boost trend growth by 20
yeah,
basis points.
yeah,
20 basis points.
Yeah.
I love
Yeah.
it. The middle one is just so marginal.
Yeah.
right.
Like, oh, we could get 20 bips, Yeah, there was that like was it the Federal Reserve Bank of St. Louis? Somebody put out some crazy chart. They might have even been referencing this chart that showed like it could do this, we could have this, or we could have this like it ends
I
humanity.
think
Yeah,
Is
that's
that
the
that's
chart?
chart.
I was
Yeah.
like,
that's
talk
VFD.
about like a absurdly leptocurtic like distribution where just the
Yeah.
tails are so bad. Anyway, all right. Well, so Jay, I got the hair went up on the back of my neck a little bit around like the Nvidia quarter, right? Because the way that the unwind that happened in the morning, and like we reversed a bunch of it, but it got me thinking that I was like, if if the hyperscalers stocks go down, keep underperforming, and there's pressure on them about this capex spending, what happens to this like this whole trade the whole trade if we get like the one of these guys comes out and just says like, oh, all right, well, all right, it's not going to be 200 billion this year. It's going to be we're going to spend 180. It's not going to be it's like I'm like it feels like the bottom would come out of a bunch of the trade very quickly. If people just thought it was changing just even at the margin slightly. I don't know if this is the best way to enter this topic because I really want to get to the topic of like how sustainable is the investment in sort of infrastructure we're making to support all this, which is kind of like drive what a big theme inside the industrials.
Industrials trade on orders, so rate of change of orders, if that comes down, these stocks will stop working, and they will either go flat or they will go down depending on the trajectory. But when you have an acceleration in order, book to bills, like a GE Vernova was like 2, it was a very strong book to bill. The comment was that the order rates are eye-popping, right, in 2025. We can talk about why that is. It's not all AI at all. It is, a bunch of things, but that is the way they trade. They trade on orders. So what you would look for if those Capex numbers come down, what happens to orders? If the orders decelerate, the stocks will stop working.
Yeah, just the only caveat I'd say to what you're saying, RPK, is like if you step back and you pull up 5-year charts of these hyperscalers, and we're only talking about 4 to 5 months of underperformance of these stocks. And the only one that looks really bad is Microsoft, but there's a whole software angle going on there. So I honestly don't think that this hyperscale underperformance because of the Capex thing is as big of a negative as people are thinking. Let me explain. Netflix, when Netflix came out and was a streaming sort of disruptor, they were negative free cash flow for years. They were accessing the debt markets to spend on content spending for several years, and they grew subs massively. Subs is not cash flow, subs is revenue. Subs is not cash flow. So they were generating negative cash flow for years. But slowly over time, they scaled. They hit that critical point. I think it was like maybe 3 years ago, where that gap between operating cash flow and capex started to sort of go the other way. And I think they became free cash flow neutral like 2 years ago, 3 years ago. And from that point on, the free cash flow has just exploded, and they have not slowed down content spending. So I kind of think of this similar to that. And if you look at the original cloud spending with Microsoft and Amazon, it's hard to disaggregate it because they were in bigger companies, but it's the same thing. Those businesses were negative operating margins for 2, 3 years. The thing that people don't know about, and I think Jay was kind of alluding to this earlier, is like we just don't have great visibility of what is. Well, we do have a little bit. We don't have looking forward like a lot of visibility of what are the products that all this investment is going to create that's going to continue to drive this revenue over time that will eventually lead to margin, that will eventually lead to cash flow. Because nobody really has a good feel for that, we're all freaking out about the capex. But so I'm a little bit more sanguine about this because I think there's two elements of this capex thing. Yes, there is investment first, revenue later. For some of these companies, is investment yes, otherwise we die. There's some existential concerns there, but I'm more in the latter, more in the former, where I think they have to spend because this is going to be enormous. I mean, Jay touched on robotics. We are not even in the first or second innings in robotics, AI robotics, and that's a TAM arguably that's as big or maybe bigger than the cloud. So and that's years ahead. We've got several years before that's going to be. You can deploy that at scale. Actually, I say that Amazon's doing that right now in the DCs, but for that to proliferate, we've got years ahead for that to happen. So I'm a little more silent about it.
I think the technology is so early stage, right? You're seeing software get disrupted because AI was developed by software engineers to help them with their job and to sort of accelerate the process of developing AI. So this, to me, I mean, I'm not, I can certainly program multiple languages and have a good deal of background. I'm amazed at the kind of code that you can just ask Chat to write for you. It's incredible. And that is just, I think, the first of many disruptions. And then as you get into, I think, these real world applications, I mean, the volume of compute is going to be insane to run a robot, right? Like that's an incredibly complex task. The current applications in something like a distribution center for Amazon, those are trivial relative to the complexity of some of the things these robotics will later do. So I think you might see like fits and starts. It may blow up and come down for a year and then pick back up. But I would be surprised if, in fact, the imperative for survival for these companies isn't to continue to invest in capacity.
Well, that's actually a great secular sort of bull case, right? Like that these, even if you get a rate of change sell off in these things as people panic about, having to comp enormous Capex accelerations that happened with the hyperscalers over 2026, that even if there's like if we hit a compares that drive a quad four kind of sell off at some point, you can still come back to these themes effectively because they've still got such a long tail on them, right? Because we're going to, you move into all this estimate of the grid usage and like the need to build out the grid. That doesn't even take into account the data center needs of all the robotics you just talked about. Like we haven't really even included that. I mean, we just call it AI and say like it's going to increase demand for grid demand by X, but like that's another exponential leap if you start doing that.
Yeah, on the grid topic, I think it's worth taking a step back that, it was, I guess, in sort of one of the discussion topics. One, you've had sort of increased demand for electricity from electrification, trying to get electric cars, trying to have people use heat pumps for their houses, things like that. Another thing is that they killed off, these grids had and generation plans were in place across utilities, and a lot of them had things like offshore wind, onshore wind, and some other green projects that then were canceled by the administration. So you see this, you even hear that on a lot of earnings calls. That drove suddenly a very rapid reorganization of plans towards combined cycle gas turbines. So then you see more orders come into GE, Siemens, and whatnot for those, mostly because of a policy change, not so much because of anything related to AI. And then you just have a history in this industry of sort of falling demand, right? It's been a really bleak demand growth environment since 2000 in electricity. And you've had just the assets age. No one felt the urge to replace assets. In fact, we were retiring nuclear.
I mean, we're getting rid of them, right?
Yeah. Now you suddenly get this, what is in the grand scheme of things, single digit demand growth from things like AI and data centers, and it causes a total panic because in part it's against old assets that need to be replaced anyway. It's against this change in policy that undermined some grid planning, capacity additions. I mean, I think the offshore wind was like 3% of US capacity that got canceled, right? That's not trivial in the grand scheme of things. And then on top of that, you get one other thing. Oh, yeah, this electrification initiative.
Yeah, and I'd even add like too, the other thing that I don't know, you've probably done math on this. I haven't actually done the math in a while, but it was like think about how many efficiency initiatives we were pushing over the last 20 years at the same time that we took our very energy intensive industries and pushed them out of the country for the most part.
Yeah.
And so like we were doing that and we had this efficiency initiative, and what I often talk about, like especially with the biophysical economics group, is like that efficiency is a fascinating thing because it gets exponentially harder to get more efficient, right? Like you can never be 100% efficient. So the more you get closer to that, it goes up, the harder it is to get more efficient. Like that's just, it becomes, it takes even more energy to create the efficiency than may even ultimately be worth it, which is why you can never sort of reach, sort of the asymptote way below that, 100% obviously. And so we had these initiatives of putting on like all this Energy Star, all this stuff has been going on for like 20, 30 years. Like, it's kind of like there's no low hanging fruit there anymore. Like everybody's got the Energy Star.
That's
like,
not true. That I will. So like lighting used to be like 20%. It's the cautionary tale because now it's 10% of usage. But the biggest offender, I'm probably an energy wasting person, so I hesitate to use these loaded terms like offender. But HVAC, like just keeping your hot water in your house and making it hot and cold, is something like a quarter, 27% of U.S. energy usage, electricity usage. And we've systematically, in some areas, made things more efficient. But in the case of HVAC, because of all the refrigerant changes, we had the ozone layer issue, right? We keep changing. An HVAC system to replace it today is like 2 to 3x as expensive as it would have been in, say, 2000, because you can't use R22 anymore, and they're high pressure, and they just kept changing the refrigerants. It just got very expensive. So you have a lot of really old HVAC systems out there that are very inefficient, even though they've tried, to make the efficiency of new systems better. The actual installed base, the things people are using, are super old because it's just super expensive to replace what you have. So people put tape on them. They buy illegal R22 and
Right.
hit the ozone layer. So there was stuff in the IRA that tried to address some of that, trying to get heat pumps in people's houses, but you could easily see 5 points of power come out of the HVAC efficiency, or people just insulating their homes would be useful, including me. I should insulate my home better. So there are ways you probably won't see like a halving the way you did of lighting costs, but you could definitely see 20% HVAC come out.
Oh yeah, no, that's a great point. That's a great point. I guess my point was just to kind of make a similar point, which is just that the rate of change slows. Like the ability to like continue to get those efficiency gains slows down. So like whatever was at work is kind of slowing, and the amount of work you have to do to capture those gains is like change out an entire commercial HVAC system. That's a bigger deal than changing out your light bulbs. Like, or when you buy your next dishwasher, buying the nice one, like buying the more efficient one. Like these things become much bigger projects to try to capture those incremental gains, if that makes sense.
And if AI is a higher value economic use for electricity, another one of the problems is that the market is regulated. Users aren't competing for scarce resources. They don't want to disadvantage existing users of electricity by giving them higher prices, right? And maybe the prices should be higher. Maybe people should be more mindful of how efficient their HVAC system is if it were a true market rate. Or maybe generation capacity would be a lot cheaper if it was a less regulated market.
That's a fascinating point, because that's actually kind of what was the argument people were making about like oil and gas for a while too. Like I remember thinking like, well, then you should let the price go up, because then people would, if you're trying to move people off of these things, then stop trying to knock the price down every time it goes up. Like let it just go, and everyone will migrate off it. It's like everyone would buy an electric car if all of a sudden it costs $150 to fill your tank every time. Then people would figure it out. Like, all right, now you don't have to incent them; they would do it, right?
Markets are the least worst way of allocating scarce labor and resources.
There you go. Well summarized. All right. So maybe the other topic I wanted to get in on the industrial side, just because these have been, the transports have run, and I want to sort of I think I had previewed to you earlier, just like the freight index. I don't know how good a proxy that is, but it looks, it's still mining like new lows. So the question I sort of was raised for me is like, how much are the stocks already discounting sort of this recovery, and how certain are we of the recovery? It's like, if not now, then when, right? When it's this low and the index is this low, is it just an easy comp? And so it has to get better kind of thing, especially where we've seen some of the leading indicators, or are these stocks getting ahead of themselves just because we haven't really seen the freight turn yet?
Yeah, I think the cool thing to understand about transport networks is that its capacity is driven more by velocity than it is by really anything else, Capex, labor, any of that stuff. So if the network got super congested in the pandemic in 21 and 22, so you had incredibly high rates for things like trucking, we shorted into that because that was the kind of a dynamic that you would see unwind, right? Congestion happens, and then over time, network speed back up. And if the network goes 10% faster, that's kind of dynamic, the numbers we were talking about in that time period, you end up with 10% more capacity, and that is the kind of thing that really moves pricing. So they added capacity during congestion, and then it sped back up, and now there's just been systematically too much capacity in things like trucking for really the last 2 to 3 years. And now you've entered a situation where the administration seems really intent on making truck rates go up, which is again one of these like problematic reindustrialization points where like, we're going to reindustrialize America by making trucking expensive. That's the plan, right? You're like, okay, yeah. But it isn't the worst group of people to help out. When you see things like tariffs, right? Tariffs have negatively affected volumes. So one of the things that I think the transport stocks, and we had FedEx as along into this, was that if IEEPA got overturned by the Supreme Court and Trump didn't have his tariffs anymore, then the volume response would be enormous. You would end up with more congestion, because when volume flows in like that, you end up with congestion, rates would spike, and these stocks would all be awesome longs. And sort of into that, we actually took FedEx off, saying like, I don't want the open the envelope risk on the Supreme Court. And the Supreme Court did vote to sort of make IEEPA not an appropriate rationale for the administration's tariffs, but they just switched to Section 122. And when we did it out, it's like tariffs before the Supreme Court decision were 16%, and now they're going to be basically 14%, right? Like not a big change. So I think a lot of transport investors were positioned for reduced tariffs, particularly with midterms coming up. Like, why would Trump want to screw his own economy into midterms? I don't know. He's keeping the tariffs on at least for 5 more months, and that's going to restrict industrial activity. And at the same time, they seem to do things to, and I think if you get into trucking and you read a lot of trucking, like a lot of these are appropriate safety measures and things that, probably it's good if drivers can read English signs. Like that's probably a reasonable expectation for a truck driver. But they're trying to introduce things to reduce the size of the driver fleet. Reducing the size of the driver fleet is not necessarily the greatest way to get trucking companies, to be more profitable and for their stocks to work. And there's a lot of other policy initiatives going on in that space that are tricky. But I think really what you're trying to read, whether it's in rails, trucks, is what happens eventually with this tariff regime, because it is something that really clamps down on volume, and it really is, again, like if you want to create a reindustrialization, don't put tariffs in place. There are literally no examples of high tariff countries that have been successfully, industrialized for the most part, right? Unless they do something like manipulate their currency or have a robust industrial policy that impoverishes their people so that they can make more widgets, right? That's what you see work in a place like China during its development, in my opinion. But yeah, we don't have that here, and I think tariffs are sort of the key dynamic for transports.
I don't know, Sam, do you want to jump in here? I don't know if you have any. Do you have? How are you? You got exposure on in the transports?
Yeah, JB Hunt and UPS are the two holdings there. And the stocks have done well. Obviously, the results recently were in the last quarter were pretty good. But I mean, to Jay's point, I think, you know, companies are still trying to figure out the lay of the land with regards to tariffs. And we just had another, stick of dynamite thrown into the room with regards to this IEEPA decision and the confusion now post that with what is the policy now? What is the administration's policy? Is it 10%? Is it 50%? Or are they going to go to another statute like Section 330 and come up with another set of tariffs for another group of countries or products? So I think that sort of uncertainty after, ironically, before the IPO decision, we kind of had got to a point of like, okay, we kind of know what we're dealing with, so we can work with that. And now there's just like mass confusion again. So that's not good. So the areas where there's like just line of sight of investment in the country in terms of infrastructure or projects that are happening that are going to go on regardless, because the money's there and the signals there, those are going to happen. But like the general day-to-day trade back and forth, nation to nation, that's like sort of like everybody's sitting on their hands going, well, what do we do now? So that cash freight index was somewhat depressing, but how long these stocks hold up, you know, it's hard to say. Like you're starting to see some of the macro data turn favorably on the industrial activity side, so maybe it's coming and it's just a matter of time. But hopefully, behind the scenes, the administration is just like just kicking this to the corner and letting the companies just continue as normal.
I mean, I guess that's sort of the question I guess I was trying to get at a little bit, is that if we're seeing a pickup in overall industrial activity, right? I mean, the rule of thumb on these things used to be, now granted, this has been a prolonged kind of downturn on the industrial side. But the rule of thumb used to be, you buy these stocks when the PMIs are below 50, right? Like you want to buy them when they're below 50 and then sell them when it's actually above 50. And here we are kind of just getting above 50 for the first time in a while. So the question becomes like, do you want to, how quick on the trigger do you really want to be if we're just kind of coming out of a sort of maybe a multi-year downturn in some of industrial activity? I don't know, Jay, if you want to add to that.
The way industrials tend to trade is that you get a lot of the alpha early, right? So as soon as you're sort of at that inflection point, and I think we had a lot of it, right? You just saw this massive outperformance over like the last, whatever, 2 months in the sector where you started to see ISM look a little bit better. I think some of that is, I think the industry, I mean, earnings calls were very focused on the potential for tariffs to more or less go away in this IEEPA decision. I think there's a lot of hope that there'll be like stimulus in the midterms, that some of these one big beautiful bill measures that come in will be very stimulative, and that it's just been really bad for a long time, and therefore it will come back, and you tend to get the alpha early. I would say that it wouldn't shock me if some of the initial strength we saw on those ISM readings fades a bit. One, because you're just going to have lousy weather, and that's going to be harder on sort of overall activity, and two, because some of the, I think, the expectations for more supportive policy really haven't emerged, right? Running around immigration enforcement isn't like industrial production positive. Tariffs are industrial production negative, right? A lot of these sort of key initiatives that I think people would expect on some level, the administration's priorities to focus on that kind of reindustrialization are exactly the reasons why we don't have industrial expansion in 2025.
Yeah, I think that's a great point, Jay. I think a lot of these distractions have at least right now, and we'll see what happens in the next few months, particularly leading into the midterms, is that there was expectation for for a pretty dramatic housing related bill to stimulate housing supply, and then on top of that, you also had expectations, which I still think is going to be coming, is banking reform and just some streamlining of the regulations to allow the banks, particularly the big banks, to sort of unlock some of their balance sheet. But those two things have yet to really happen because of these distractions, as Jay was mentioning. And those things would have been additive to the one big beautiful bill if they were all sort of starting to kick in over the next few months. But we just haven't seen it. RPK. We were talking a while ago about the government potentially like coming out with proposals to streamline, uh, you know, um, projects around infrastructure and power and transmission lines and all that stuff. They were talking about it months ago to kind of make it easier. Where has that gone? We kind of need that yesterday, and
Yeah.
we haven't heard
They've,
jack
they've
about it.
they've
So
moved on. They moved on
yeah,
to going to foreign affairs is now
yeah.
what they're
I mean,
Capping
focused on.
credit
They're not.
cards rate,
yeah,
capping
but
credit card rates at 10%.
these companies are not standing still. They're spending all this investment behind the meter where you don't need the grid connection. You don't need the state to approval. You don't need to negotiate with the utility. You don't need to worry about rate increases to the public. You can just build everything behind the meter on site and you're a self-contained unit. It's not efficient at all. But at this point, they don't care. They need to get the thing up and running.
Oh yeah, and there are a variety of investments that could be made that would, I think, greatly simplify some of that grid storage, things like that
Right.
just take time.
Right.
All right. Well, we do have Jay on, so we couldn't get through this episode without doing a little bit of Tesla talk, for sheer entertainment purposes. No, actually, yeah, no, that is exactly what I'm doing. But I do want you to help like settle it, settle a debate/discussion, that Sam and I have had back and forth about whether SpaceX really can come public, right? Um, or they ultimately have to merge it with Tesla, because I just don't know how he could possibly have these two vehicles out there and sort of demand the cult capital in two entities, especially if one then doesn't. Tesla's just, a car maker that doesn't make cars kind of thing. Like I don't like, it almost feels like he has to merge these, which makes me afraid of being negative on Tesla, because if the day that announcement comes out, I don't even know what the cult leaders will do with that. I don't know. I'll put a penny in the, I'll put a coin in the machine and let you go on that.
I think that the SpaceX IPO valuation was really disconnected from anything that would be reasonable to public investors. I mean, you're talking about like a $40 billion space market. How big could, there's competition entering Starlink that's quite significant next year, and a $1.5 trillion valuation is a bit high. I will, whatever, it's a podcast and it's for entertainment purposes. I would encourage everyone to look at Elon Musk's participation in the Epstein files. He was a frequent corresponder. There is a whole set of, I didn't know this until I read it in the Epstein files, right? That Epstein brought 2 girls, assistants, on a tour of SpaceX in, I think it was 2013. And, there were 1 South African, 2 Russian. What happened, I don't know, but then you see another email where he's like, you would have had fun, thanks for the tour, you would have had fun at Christmas. And Musk responds, oh, I see. Like that kind of thing is problematic. Musk is a famous user of Signal, right? He doesn't actually write emails. Those emails stop around 2014, right around the time that conversion happens. And we don't know what happens after that. But, I think it's when you look at the Epstein situation as a blackmail operation, right, which I think Lutnick said it was. I don't know whether you guys think that, but possible, certainly has that vibe. Having a defense contractor CEO targeted in that way and obviously enter that kind of fold isn't great. It's not a good look for Musk. It seems to not be going away as an issue. It's very hard to sort through. But I imagine that is a part of his rationale and motivation, given that he got in a, he actually literally said like Trump isn't releasing the Epstein files because he's in the Epstein files, and you're like, oh well, that bet didn't work because you're also really, really, really in them, and that is kind of shocking. It was something I didn't see coming. We saw pictures of him with like, Ghislaine or whatever, but it's very hard to say that there's anything like that. But if we do know one thing about Musk is that he's a little weird about women, right? Like there's like definitely something going on there. So yeah, I think that's a dynamic that will definitely actually matter in the case of the SpaceX IPO. Like, is this a person? Now you have Grok at the Defense Department, right? Like I don't know. Is the guy compromised? You got Epstein emailing with Ehud Barak, like all these people offering information on Trump to the Russians, right? These are just like in the guy's email.
Between Starlink and the Defense Department and the space, he's a prime target for being for attempted compromise, to compromise. Come on.
Epstein was trying very hard. He was definitely keeping after the guy and checking in. And we don't know exactly what happened, but my guess is you'd need some of those questions answered, having actually gone through and read the emails. He literally did ask, like, what day night is the wildest party on your island? Like, that's literally something he wrote to Jeffrey Epstein in 2012 or 2013, like years after he had been, jailed for, soliciting underage prostitutes. I don't know what the exact charge was, but it is something that is an issue. I'm surprised it isn't more of an issue also for Tesla because it looks super bad.
You're kind of making my case that they are going to end up merging.
I was just going to say, I think you just... Did Jay
he's
just
not going to do
confirm
he's not going to do another roadshow for another vehicle. He's going to put these things in Tesla. There's almost no other way to do this.
Well, SpaceX is a last as I understand it, loses about $500 million a year, has about $15 billion of revenue, and is a postage stamp then relative to Tesla. And Tesla itself is quite troubled because of the lack of EV subsidies and the incredible overcapacity and brand competition within the EV space. It's going to be very hard for them to make their way through 2026, as well as some reduced subsidies globally. So I think it's a tricky situation for Elon. He's in a dicey spot.
Yeah, it just seemed to be. I was going there mostly because the cars are old, right? They haven't been refreshing these models, and so there's competitors who have better better stuff out there. I mean, there's other, or at least new stuff. Like I don't, we can argue whether they're better or not, but there's new inventory being put out there by competitors where you buy a Tesla, it's an old car. It's been around for a while without any really substantial any design changes. Um,
Who doesn't
and
want a Lucid that's a $500,000 that they only charge you 200K for, right, Jay? Isn't that
Yeah, I was like in it. I ended up with David Salem and I both. I have EQSs, and I was like, yeah, it didn't cost as much as a Lucid to make, but it probably cost like $300,000, and I can get that for like the equivalent of like 60 grand or whatever. I'm in. I'm a value buyer.
hey, I live in Massachusetts. Well, Sam can attest to this too. Rivians are like the new Subaru. They're everywhere. They're everywhere around here. You can't. I could throw a rock and hit one of these things. They're like they're driving around all over the place. So I don't know. They're probably not that popular everywhere else, but they're definitely popular around here.
And they're a good-looking car, and they're in a category like a full-size SUV in electric cars that is not that popular. That's not that populated, right? There aren't that many. The EQS, I have the SUV EQS, right? Why? Because there aren't that many, 7-seat SUVs that are electric.
Yeah. And so, I mean, that's kind of point. So coming back to that point, it's like, so you have to start spinning stories about robots. That's fine, but like $100,000 humanoid robot ain't coming anytime soon, especially one that you could put in someone's like house that wouldn't be a massive liability. Like if it kills like your pet or like breaks your elderly grandmother's like arm, like they're in for a multi-gazillion dollar lawsuit. Like, so I don't like,
Exist. I mean, they move seamlessly from a car that doesn't drive itself to but does have some very good ADAS. Like instead of just pitching the thing that they do have, which is an excellent advanced driver assistance program, they moved to humanoid robots, and if you follow Tesla, they've had like 50 of these things. I mean, like there was the lithium mining with table salt. There was a Tesla streaming at one point. I mean, there was Battery Day. They had some cool new battery. They were going to make motors that didn't have rare earths. I mean, it's like if you made a list of all the bullshit, lies, or whatever you want to call it, that they put out, I don't know.
Funding secured.
Yeah, funding secured. I mean, the guy's been sued twice for security, or sued for security fraud, and then sued for not following.
Well, who's counting, Jay? Come on.
Well, I want to be careful because you don't want to overstate it. It's just like I wish I had never picked up Tesla. It is the most annoying thing I cover. There's always some bullshit in the news that everyone's talking about, and it's like it's the flood the zone strategy, right? There's just always something there, and I think honestly, if you just go, like there's this thing called Jmail that organizes Jeffrey Epstein's email much more easily. You can go through Elon's emails with him, and everyone knows that Elon doesn't email. He uses Signal, right? So the fact that there are these emails is amazing to see. They look terrible to me, right? And I think that's probably where Elon is.
All right. Well, I'm glad you covered it because that was highly entertaining. Good. All right. Well, so maybe I'll just kind of bring this into, we can start rolling in the wrap-up session here. I had a couple of questions come in from our growing audience. I'm sure that's a massive group out there that is watching these. But we hope you will be it will be growing, and that more of you will send us questions. A couple of questions that came in. I'll start with the first one because we could all kind of, I guess, kick it around a little bit. I think it was aimed directly at me because I had a stock blow up the other day. It was just how do you deal with stocks that blow up, and how do you size them going into earnings events? And that's kind of the question I think is the bigger one, right? Like, when do you want to take earnings risk and when do you not want to take earnings risk with a name? And for the most part, like, you can't really not take, like, you can't just go to cash every single time companies report. I guess in theory you could. I don't think that would really work as well as it does hypothetically, or in practice it would not work as well as it does hypothetically. So that being said, I tend to go with it's on Signal and you have reason to believe it might be good. It doesn't mean you're not going to stub your toe every once in a while. Just is what it is. There's what everyone knows that everyone knows, but then there's also sometimes literally things that nobody really guessed was happening or knew was going to happen, and then it's new information, and you turn over that card and you're like, oh well, and then it's just a question of you doubling down or you folding. And if it was new information and it's bad information and it breaks Signal, I just kind of tend to say, yeah, okay, let's just give hold and go on to play another hand. Like there's no reason to get attached to it. But I don't know, Sam and Jay, actually, I'd love to hear your thoughts too on it. Cause like, I mean, as you deal with like companies that you're recommending and like, whether do you recommend it ahead of the quarter? Do you wait? Like, I mean, I'd love to get some feedback from both you guys.
Sam, you can go first, and then I'll cheat off your work.
Sure. Yeah, I mean, I agree, Patrick. I think it's very case by case. I mean, just this last earnings season, there were a handful of names where I had decent sized positions in, and I went into the quarter heavy in those positions because I felt really good about the fundamentals, and so I was willing. I was confident enough that the fundamentals were good enough that I wasn't too worried about any negative surprises. But then there were others where, there were a few that ran into the quarter, um, not necessarily because you know specific fundamentals for that company were coming in better. It was more like maybe a competitor reported and it had really good numbers, and the stock went up a lot, and so it kind of lifts everybody in the space. And so now you're going into your company's numbers somewhat sort of elevated because you rode the coattails of the competitor. So, Akamai, for example, was a great example of that. Fastly, which is a smaller competitor, had surprisingly good numbers. The stock was up over 25% the week before Akamai's earnings. Akamai, between the Fastly number and their number, probably traded up over 10%.
Oh yeah. Like, oh,
So,
yeah, yeah, easily that. Like, and
yeah,
so I think, yeah, to your point, if they had gone first, they
yeah,
probably would have been up on the
right, right,
same
right, right.
news. But it's like then it runs, and then you're like, oh, well, that wasn't as good as we hoped. You're like, well,
Yeah,
yeah, but you weren't 3 weeks ago. You weren't thinking it was going to be good at all.
yeah.
That
So
it
like in that
changes.
example, I trimmed a little bit on the Fastly bounce, and then I trimmed the day before the Akamai report. Um, and so the position came down. I still owned it. It was a good size, but it was like half the size it was
Yeah.
before. And then they reported it was viewed as a disappointing, which I agree with you, Patrick. I think in isolation the numbers were really, really good. Um, but given the context, it was viewed as disappointing. So and the stock got hit, but I don't think it changed the fundamentals, and that's where, and it also didn't break signal. So that's kind of where, like, just it is tricky. You really have to deal with it case by case because there's no one thing, and there's no way you can avoid the grenade. It's impossible.
Yeah. I mean, you're
So
always going to get
you
some
have
of
to
them.
expect you're going to get shrapnel wounds,
Yeah, I always
and
go into every earnings season assuming there's
yeah,
going to be
yeah,
at least a couple of these. You're just not going to. And the good news is, if you're doing it right, hopefully you have a few on the other side, so it all washes out.
right,
Like you have a
exactly.
few that are surprised that go up even more than you would have expected on the news, and that's fine. But like you gotta,
It just comes with the territory, man.
it comes with the territory exactly.
Yeah.
I don't know, Jay, did you have any sort of thoughts? Anything you want?
I have so many thoughts on this topic. First, I completely
Great, we could
agree.
just stay here for the rest of the afternoon.
There's like the first half of earnings season where everyone's sort of in the rebasing of expectations process, and then they get rebased, and the second half of earnings season feels totally different. I would also say that I very rarely ever had great alpha and a good earnings season. Like somehow they don't necessarily always correlate. Like maybe everyone works on earnings so much that that you get that one day move and then it doesn't actually correlate all that well to the stock overall. I would say we invest an enormous amount of time and resources in data trackers. For our team, there's a lot of stuff that you can track and see and build your models around, and that's helpful. Like if your tracker is bad and you're heading into earnings, it's like you're in poker and you just get dealt a 2 and a 7. You're like, fuck it, like I don't need to play this, right? So you can fold early. There are also times when you're just like, oh my God, I have an amazing earnings report in my hand. Why the fuck is the stock down? And that's just because someone who owned it was using liquidity on earnings day to exit for whatever their reason is, rebalancing. They don't like it. They want to own software down here. Who knows, right? There's a ton of things that happen in the markets that are really noisy. And I had a couple of those this earnings season where you all know, you all watch the call, like where I was like, I don't know, it's down in the pre-market. I think the earnings report reads great, and then it just goes down all day further, which I kind of hate. I hate that a lot. But I think it also used to be easier, like 15, 20 years ago. You could look at like an earnings report, and the estimate was at $2, and they raised guidance to 220. Stock's going to be up plus or minus 10%, right? And that whole dynamic is gone, right? It doesn't. It's very much noisier in response to earnings
Yeah, what's gotten so twisted around the axle? Like I feel like when I was working at, like when I worked at the hedge fund side, and we used to have like a discipline because we were carrying big chunky positions on through, and if you were holding it, you had to make a call as you were they're going to hold it for earnings or not, right? Like that was kind of the thing, was like you had to make a call, go or no go decision 5 days before the company was going to report. Do you want to still be long this or not? Do you want to take the capital down? And if you were going to keep it on, one of the good hygiene exercises was you had to effectively write the press release you were expecting to see, right? So you kind of had to like sit there and just be like, this is what I expect them to say, right? So that when it came out, you could just immediately be like, how do these compare, right? And to your point, it got to the point where it's like, how to look? It's like, well, it looks exactly how I expected. But was it better than you expected? And you're like, no, it was just as good as I expected. And they're like, then we probably want to trim that. It's just this like, it just becomes like, I don't know. I always call it like this, like that scene in the, I'll date myself with movie references, but you guys are all old enough to be equally dated by this reference. In The Princess Bride, when the guy's doing the whole thing of like, yeah, but you knew that, so therefore I made this. Well, everyone knew that it was going to be really good, so I actually sold the stock before that. You're like, right, but everyone knew that we would want to sell it beforehand, so I bought. Like, it's just like the positioning just creates insane volatility around these events as everyone tries to figure out what everyone else thought everyone was waiting for.
The Princess Bride is not an old movie. I will die on that hill.
Dude, that's an old movie. All right. Maybe one last question we'll get to, and then we can close this out. Just quickly, Sam, we can keep this short because this one came in kind of for you. Was around position sizing outside of your top ones, because your top ones are really chunky and they tend to be kind of mirroring the underweights or overweights of the things you wanted to that are chunky in the benchmark that you have to be cognizant of. But what about the rest of like the sort of the tail below that? How do you think about, what's your mechanism for thinking about position sizing?
Yeah, I mean, I think about it as like, an average position size is for those other names are like 1% or 1.5%. And the more conviction I have in it, or if it's a name it's proving itself, it'll be closer to 2. And if it's a new position where I'm just starting a position, for example, it's like 50 bips. I mean, sometimes I'll go in, straight away with a 100 bip position.
That's your active weight, right, Sam? Or is
that's the active weight. Yeah.
We've spent a lot of time discussing, kind of the way you think about the world, which I really appreciate.
Yeah. So I think sometimes.
So, and to be clear, what does that mean, active weight?
Yeah, so active weight means like, your position size minus whatever's in the benchmark. So if there's a stock in the benchmark at 50 basis points and you own 2% of it, your active is 1.5. And particularly, in the relative world of investing, if you're trying to beat the benchmark, that's what you're paid to do. Otherwise, if you would have been an index fund or an index. So if you're paid to beat the benchmark, that's your bogey you're trying to beat. So I always think about things in active terms. But to just finish up, Patrick, I think that would be the sort of general band of like sort of 1.5 being the average size, and going up to 2, maybe 2.5, and then 50 bips is always usually a starting position.
Yeah, I mean, it's kind of funny, right? Because I mean, with the concentration that's happened in these benchmarks over the last 10 years,
there's concentration?
Everything below the top 10 is basically all active weight, because like the percentage of actual weight in these things, especially when I look at like the 1500, it's like the top 20 names are 45% of the benchmark. Below that, it falls off to less than 1%, like really quickly, and then it
Yeah.
just goes to like, tiny fragments of size, which is like, could be like, oh, I buy 200 basis points and I'm active 180,
Yeah.
yeah, okay, sure, I mean, whatever.
Whole lot of 1 basis point positions out there.
Yeah, exactly. All right. That's good. All right. I'm gonna close this out. We usually do something fun, pop culture minute. I was trying to come up with something. I realized here's probably the place to be. We got a couple weeks. You have a couple weeks to watch the Oscar nominated movies. I was trying to figure out if I'd seen any of them. So my question is, A, does anybody know what's actually been nominated? And B, if so, have you seen any of them? And C, if you've seen any of them, were they any good? I'll start with our guest, Jay. I don't know how many movies you watch, but have you seen any of the Oscar nomination movies?
I watched the Olympics a little bit, but I don't believe I've watched any of I don't think I've been to a movie theater in a little while. The last movie I really liked was Gran Turismo. Not Gran Torino, but it was like this racing movie where these like video game players get to race real cars. I made my kids watch it.
Yeah,
If you
yeah.
didn't see it, it's like about dads and it's about like working hard and people doubting you, and it's a beautiful movie.
Oh, that reminds me. I think I did actually see one of the movies that's nominated. I think F1 is nominated,
Yeah,
which tells
it
you how
is.
dangerously overscraped the bottom of the barrel is when they're like, that's up on like as a best picture. But it was like I went on a whim and like going over the summer, and it was entertaining. My bar was set pretty low, and it was definitely entertaining relative to where I'd set it. I don't know. You got Sam, John?
The last movie I saw in theaters was the most recent iteration of Point Break, which was trash. So I don't think I'm gonna be able
But you
to
don't want you don't want to go
be helpful here.
remaking. You don't want to remake movies
I
that were
mean, I
really
should
good the
have
first
known,
time. You
right?
remake
Like,
movies that were bad the first time. You don't remake movies that were good the first time. And you, given your parental situation now, you won't see another movie in the theater for like
probably
years. I'll
not.
check back with you in like 5 or 6 years. Maybe you'll have seen one by then. And then it will have been whatever Pixar had just put out. All right. Sam, anything? You're a movie buff. What have you seen of the ones that are up?
Yeah, I mean, like you guys, I haven't been to the movie theater for a while because it's just a big time suck. But I've seen some of the movies that have been nominated, and I mean, I thought F1 was pretty good. I think the one that's going to win, which is one battle after another, I think that's going to probably end up winning. That was pretty good too. Um, you can these days with movies, particularly the last 10, 15 years or so, you kind of have to know what you're going to expect. You kind of set your expectations before you go in because you can go into a movie thinking A, you come out thinking, oh, that was the freakiest, craziest thing I've ever seen on screen. I will never go to the movie theaters again. So you kind of have to educate yourself before you go into this because the last thing you want to do is come out of a movie feeling disturbed. And too many disturbing movies these days.
Yeah, there's a lot. I think that's I noticed like when I looked at like the theater listings, it's like almost all of them are like horror movies because I think that's the only thing that they can guarantee bank on. Like people
Yeah,
like the young people will go out to be scared in the theater together and
right.
like that's about it. So like and I'm not a big horror movie guy, so I'm sort of like, yeah, okay, I don't need to see that. All right. Great. All right, Jay, thank you so much for joining us, being willing to do this.
Thank you
It
for
was
having me.
awesome having you on. We'll probably hit you up at some later date to do this again. I hope you'll be down for it. It'll probably be around when the SpaceX Tesla merger happens. We'll bring you on to follow up. In the meantime, I think tune in for the next one. I suspect I hope we'll be doing this. We'll try to do this in 2 weeks. We'll do maybe mid-March. Get a St. Patrick's Day episode in and cover. I think we're going to talk. Maybe we'll talk software. I mean, as if we haven't already talked about software enough. But I do kind of want to do. I know Sam and I were talking about doing an episode where we sort of start to sort through like how do we don't want to pick a bottom, but when the bottom starts to be in like what's probably going to come out the other side, like how do we want to even start thinking about how to rank who's probably okay and who is going to benefit and who is really in danger? And I think coming up with some frameworks for that and talking through it would be good. So maybe we'll do that one. I know Friedman was up for maybe coming on and talk about that. So In the meantime, you can follow me on Twitter or at X. Sorry, Elon, I can't stop calling it Twitter. At RP Kent. You can follow Sam at Sam of America. John, are you on X? What do you go by? Or are you just the Hedgeye AM? Is that your?
Yeah.
Yeah. All right. Fair enough. And I think Jay, is that Hedgeye Industrials?
At Hedgeye, INDSTRLS, because we hate vowels.
Yeah. That feels very like 5, 6 years ago, or maybe I don't know. Remember when
It was
everyone was
like
doing all
100
the
years ago. Yeah.
I'm too old to know, man. I everything feels like it was like, oh, wasn't that like 2 years ago? And you're like, that was 20 years ago. You're like, yeah, okay. All right, very good. Anything else? Anything else to add, or should we close this out? It sounds like no. All right, good. All right, best of luck out there. Thanks for joining us, and I hope to see you on the next one.